So tax rates are going up. You have time to prepare. 12/31/25 is the expiration date. Will they be extended? Who knows? But you want to be prepared. The best way to be prepared is to ensure that you are always updating a Form W-4. This is telling your employer what to withhold from your wages. When you're now filling this out, at the beginning of January is when the new tax brackets come into play. This is going to be in 26. Now listen, that sounds like a far away time, but you want to be prepared. How's a way that you can be prepared? Well, I've given you a link in the body of this video here. And if you go and you take a look at what we're now talking about here at the IRS website, you can use this use tax withholding estimator. And where this really comes into play is if you are filing with a spouse. And I'm telling you, in 32 years, I've never seen married filing separately ever as an advantage. But when you are doing that, you can select your status and you would just continue to go through the questions. Now, this video is not related to that, so we're going to now continue on. JJ the CPA here. Hope you're doing well. Wanted to go through with you what I'm talking to my clients about right now. And what we're looking at here is a sunset of tax laws. And when we say sunset, that means it is happening. No politician needs to do anything except let it expire. So we want to talk about some tax planning with the end in mind to be sure that we're prepared. Again, these are laws that are expiring 12/31/25. This means starting in 26. What you don't want to wait for is April 15th to figure this out in 2026, or by golly, not in 27, and then be surprised. Even though this sounds like it's in advance, what we're looking at here is new rates going up. So you look at this and you think, well, what's the big deal? Well, in this graphic here, we're going to look at the far right because this is now what the rates would be based on inflation if we go into 2026. And partly what we're comparing to is the rates we have now for the TCJA. That's just the law that we're dealing with now. So 25 versus 26. And when we're talking about the different brackets, and you look and you think, well, that's not a big deal, 12 to 15, 22 to 25, 24 to 28, etc. But we now are going to take a look a little bit closer. So I've got these labeled. That's where these line items come into play. And I want you to notice here that, yes, we see it go from 22 to 25. But I want you to notice here that it goes into those rates quicker, right? So not only did it just go up, but you're now getting in the higher bracket sooner. And this is going to add up. So when we're now talking about, all right, what do we want? This is what you don't want April 15th to look like for you. So I've now blown this up and basically showing you here, when we're now taking into account going up into these other amounts, if we're now talking about down below, I've just showed, hey, it's going up 3%, going up 3%. But look, you not only went up 3%, but you got into it, boom, at a very low dollar amount. That's the really under 100,000, right at that 50,000 mark, unless you are into that. And if we now talking about $1,000, you go, it's not a big deal. For every $1,000 I earn, I got to pay another $30 in tax. For every 10 grand, 300. You think, it's not a big deal. But basically in that first 50 grand, talking another 1,500. If we go up to 200,000, that's basically where we're seeing this continual increase. But when we're now talking about the amounts above that, well, that's really going up 4%. And look, you get into that bracket quicker. See, on the left there is what we're dealing with in 25. See, we're in the 24% bracket, almost just under 400,000. And now we're going up 9%, where currently we still would be in the 24% bracket. Now it only goes up 1% there. It's the same for that little area. And then we go up 4.6, and then we've got 2.6 here. So when we're talking about what is the impact? Well, it just depends on what you're making, your spouse makes. But I want you to be prepared for this. I want you to be paying attention. And the way that you're going to be prepared is filling out that Form W-4. So again, you should be completing that every January at a minimum, anytime you switch jobs, if you get a bonus, if you have a new pay structure, because your employer is only going to withhold what you put on that Form W-4. It is never the employer's fault as long as they are withholding whatever you gave them in that Form W-4. And again, going to that estimator, don't get overwhelmed by it. Click on it, answer the questions. IRS doesn't know who you are. You don't provide your Social Security number, but you can run scenarios and then it will tell you what to fill out related to the information needed on that Form W-4. It's very crucial when you have two types of income, or I should say multiple streams of income coming into your individual tax return, because withholdings from wages is only going to be based on those wages. So if you have interest and dividends and capital gains or retirement or small business income, etc., you have a spouse that's also earning, that's where you want to ensure that you're staying on top of this. All right, hopefully that helps you. All right, hey, thanks for tuning in. I'd love it if you'd subscribe, and then don't you ever forget, you've never met a CPA quite like me. You have a great one.